Good morning, everyone. Hope that everyone is doing well. Terry Cook here, coming to you from the beautiful city of Charlotte, North Carolina. I've been asked to make a presentation for a couple of marketing organizations that I'm working with, an insurance company, and they've asked me to just kind of tell you exactly what I do, some of my experience, and so we'll go from here. My background, just a little bit about me, been in the business for over 40 years. Started as a college agent for Northwestern Mutual. I've been an agent, a general agent, national VP of recruiting. Most recently retired from being the senior regional vice president for the Southeast. I have a record of success. Had some failures along the way. I always like to tell people that anyone that tells you they've been successful 100% of the time probably isn't telling the truth. So I've had some challenges here and there, but I like to think that I've learned from those challenges. I'm a CLU CHFC from the American College. I have a bachelor's degree in interdisciplinary studies. That's when you go to school for a long time and they finally kick you out. I've helped and consulted with advisors throughout the country, thousands of them. I love to write. My most recent book is The Mortgage and the Beast, and we'll talk about that in a little while. And also, I have a book out called Referrals Forever. Also published 3 novels. Like I said, one of my hobbies is being able to write. Student of the game, I've been to, LEAP, Circle of Wealth, Think Tank. I've been to a lot of meetings over the years. I like to think that I'm a student of the game, still enjoy studying about the business, always more to learn. Most importantly, the father of 3, husband, 9 grandchildren, which is the most fun right there. I love golfing, coaching, riding, grilling, traveling. Super fan of the Panthers, which it has not been fun lately. Also the Tar Heel basketball. Love the BYU Cougars football team, and love the business. What my goals and what my value proposition is to help life insurance companies, IMOs, independent marketing organizations to expand their opportunities and consult and share insights. And my goal is to be able to add value. When I was working corporate, my goal is still this, is to increase production, not replace your current production. It doesn't do you any good or me any good if I come in and replace a few $1 million of production, and instead of going somewhere else, it's going to me. What I want to do is be able to add on to your current production. I always tell people I like to find new fishing holes, new markets for you that maybe you're overlooking, some markets that you might be able to penetrate. Also want to help insurance companies and marketing organizations help with their concentration risk. A lot of them have are concentrated in 1 or 2 markets where they're getting the majority of their production. Don't stop that. Continue with that. And like I said, what I want to do is to hopefully be able to help you find some new fishing holes. My fundamental core values, I like to share these with everyone that I talk to. We are blessed to be involved in a noble cause. I believe the life insurance industry is a valuable part of our society, and it's very noble in what we do. I believe in the 3-legged stool, that when we do products, it's got to be good for the consumer, it's got to be good for the life insurance company, and it also has to be good to the advisor. So the advisor, the insurance company, and also the client. I really believe this. I've had the opportunity of delivering some death claims, and I believe that we are the light at the end of the tunnel. Let's talk about that 3-legged stool for just a minute, if we can. Let's start with one, which is the insurance company. I believe that life insurance companies are the stewards of our money. I had one agent that said they're the goose that lays the golden egg. it kind of starts with the insurance companies, and so I like to start there. To me, ratings are key. How insurance companies take care of their money. Again, they're stewards of our money, especially with mutual companies, and it's important to find companies that understand and realize that they're stewards of their clients' money. I think history is a key. That I like to work with companies that are, you know, old, um, that they have a strong history. They've been through recessions, been through depressions. I believe that the products need to be competitive. I'm not one that believes that an insurance company needs to be number one in every category. In fact, if I find an insurance company that's number one in every category, they're probably compromising something in their financials to have to be number one in every category. I want them to be competitive, but they don't need to be number one. I believe that they need to pay out a fair comp. Again, I'm not looking for an insurance company that is paying the highest on the street. Their service needs to back up the business. I believe that's very important to take care of the clients that we have. They need to be responsible. They need to add value to their advisors and need to have a long-term outlook. Number two, this is extremely important to me as well. We need clients that think long-term. To me, life insurance is long-term. We're blessing the lives of people that we may have not met yet. And so, I'm always looking for clients that think multi-generational. I have life insurance, and hopefully I'm blessing the lives of some people that I have not met yet. Clients need to have realistic expectations. Um, we sell safety, we sell guarantees. If you're into this for, you know, great returns, fantastic returns, unrealistic returns, we're probably not for you, at least in the life insurance market. They need to understand the role of the carrier, that the carrier is there to be able to protect their money and provide benefits in the future. We're looking for clients that can understand the products that they have, and I believe extremely important that they have a belief in life insurance. If they don't have a belief in life insurance or want to protect those they love, they're probably not a good match. And also, we're looking for clients that are financially responsible. Number three, the advisor. We're the third leg of this three-legged stool. I always look for advisors that, number one, have character, loyalty. We're in it long term. I always look for advisors that were loyal to me. I'm loyal to them. I like advisors that are astute business people that take a look at their business like a business, and take a look at the bottom line, how much they're spending in advertising, how much in bricks and mortar. But I'm always looking for good business people that know how to run a good business. I love advisors that are relationship driven. I'm relationship driven, and I have to have a relationship with the advisors that I work with. I'm looking for advisors that have communication skills, not only to the home office and to me, but also to their clients. I'm looking for advisors. I love advisors that want reasonable compensation. I don't like working with advisors that have to have the highest on the street. If they have to have the highest on the street, they're probably not for the IMO, or probably not for the carrier. Same with the products. I'm looking for advisors that want great products, but they don't have to be number one in all the category. A lot of these are interchangeable, but I like advisors that think long term, think multi-generational, high persistency, that take care of their clients and their clients stay with them. The first market I'm going to talk about today that I think really has a tremendous opportunity, and I've been able to get some advisors really doing very well on this, but that's the mortgage market. And I'm not talking about just mortgage protection. We'll get into this deeper, but I'm talking about the mortgage market kind of being the ticket to being able to get us in to play the game. Why the mortgage market? Number one, there's tons, millions and millions of new mortgages every day, every second. Interest rates go up, they go down. This serves an opportunity that people are constantly refinancing their mortgages. Usually people that have mortgages are ideal prospects. They usually have good income, good credit. Usually they're healthy. Um, Most, if they're buying a home, are predisposed to protect their families. Those are people that we're looking for. Um, the other opportunity in this market is that the leads, being able to get an inventory of clients is almost unlimited. You can Google that, but with the millions of people doing mortgages every year, they're fairly easy to get. Leads and prospects are fairly easy to get. Not only lead sources, but people that you know. They're also great prospects for other products, 401k rollovers, disability income. If we have agents that do assets under management, they're good in that area. The future is bright. Again, I'm not only looking for mortgage protection, but I'm looking deeper at that. Again, the mortgage is just a door opener, and hopefully to be able to get into the door and then be able to do a lot more business than just protect the mortgage. I mentioned this earlier. The mortgage is the ticket to the game. If you can imagine going to a football game, we have season tickets to the Panthers, and when we go through the portal, it's open to thousands and thousands of prospects, and that's just like the mortgage market. Is that if you're in the mortgage, it's like getting a ticket to thousands and millions of possible prospects. It is one of the most the best lead sources that you can get. And this is important because agents need people to talk to. You can just Google mortgage protection leads. And there are a lot of sources out there that you can be able to get your leads. I think social media, a lot in the old days they did direct mail, but leads are available. Leads are also a fluid market. They change daily. Sometimes there's a good lead source that turns into a bad source. Sometimes there's a bad source that turns into a good source. But there are millions and millions of people that are prospects out there. The mortgage market, in my opinion, and this is where you get into my value added, is the ultimate banking concept, infinite banking concept. And we'll get into that a little more. But to me, the mortgage market and the banking market are perfect partners. And the mortgage market, you're whoever's working just the mortgage protection, you're sitting on a gold mine. And if you're doing just mortgage protection, you're missing out. And it's like going into a gold mine and only taking out, one or two gold nuggets. There's a ton of gold nuggets in there that you can take out. Some key players that I think some people are already working with, we got Symmetry, a great organization. If you take a look, they're constantly changing. Assuria, Equus, Family First Life, Impact, AmeriLife, Unitrust. I think all of these organizations offer a lot of potential. There are also a lot of IMOs that are looking at expanding into those marketplaces, and hopefully I can help you be able to have the keys necessary and the information necessary, the training necessary, the intellectual property necessary to be able to help you expand in these marketplaces. There's just a ton of potential in the mortgage market, both with existing people. I'm sure that a lot of your advisors that you have right now, probably 75% of them have mortgages. And so it works in the independent field, both IMO and independent. It works with being able to recruit people in as well as your existing people. It works with whole life. I'm very partial to whole life. I've seen some people work in the IUL market. I like whole life, but it can work with IUL. I always say that if you're going to do IUL, make sure that you use the guarantees and do it conservatively. I believe this also has a great potential to work with bank and mortgage insurance departments. They're always looking for more revenue, and I think this could be a perfect partner to work in some banking and insurance or banking and insurance departments. Looking ahead, um, not just today as a successful regional vice president, I always started the year. I always thought that most of my production as a regional vice president in 5 years was going to come from people I had not met. And that kept me on my toes. And, obviously I needed to take care of the people that were already in the fold. But I always kind of treated my region that I needed to go out there and recruit every single day, and that I needed to have ideas and a value added platform that I could offer that was in addition to products. All companies have products, all companies have good products. Not all companies have great ideas, and not all companies have great ideas that will match with great products. The mortgage market, if you have a platform, can be a huge recruiting tool. Imagine being able to tell an advisor that we have a mortgage freedom platform where you can go out and work your leads, work your inventory, and show your clients how to save hundreds of thousands of dollars of interest and to be mortgage free. I believe that the mortgage market also for insurance companies as well as marketing organizations will diversify your concentration risk. I know of some insurance companies that are heavily involved in IBC, which is fine. I know some that are, heavily involved in the retirement market. Some are heavily involved just in the mortgage protection market, and which is fine. But when I talk the mortgage market, it's more than just mortgage protection. It's teaching people how to pay their mortgage off early and be able to match that with the banking market. Products that people sell right now are the quick issue term, quick issue guaranteed UL, that's a guaranteed premium, a lot of return of premium, quick issue IUL, doing a little bit with whole life and debt elimination. We'll talk about that in a few slides. And I know a couple of companies right now that have come out with simplified quick issue. I said easy issue. I don't know if I should have used the word issue, easy, but rapid issue. And to me, matched with the mortgage freedom market is an absolute gold mine. And if you have that or you're thinking about getting that, I know that in that marketplace, people are looking to have their policies issued as quickly and as fast as possible. A word on the debt market. I said that I would talk about this just for a few minutes. I started recruiting some IMOs maybe 15 years ago that were teaching people how to get out of debt. First of all, I want to say that you can't do anything better than to teach people how to get out of debt. And that's a wonderful market to be in. And I would say after 10 to 15 years, I would say that it's extremely difficult to break habits. And usually people that are getting into debt tend to kind of stay in debt. And I'm not saying that it can't be done. I have numerous success stories, and I've seen some new programs out now that will stick with the clients and hold their hand, and that are helping people to stick with it longer. But just know that in that debt market, it is extremely difficult to change behavior. Um, People can be put into two categories, either they're spenders or savers, and usually that runs in their veins. Um, Extremely difficult to manage the debt from the home office. A lot of people are getting loans. I always tell my agents, my advisors, that a life insurance policy should not ever be used as an ATM. And that, a life insurance policy should be used for big ticket items. In my opinion, we should be careful when we're paying off small credit card using our life insurance policy. It can be done, but we just need to be careful because there can be a lot of moving parts. And I retired from the field. Or from the home office. I'm now in the field, and it's amazing, uh, how much clients can forget. We think they remember everything that we say, and I think they will remember everything that I say. But I've had a lot of clients call me. They say, "Now, what did you say, Terry, about this? Or what did you tell me about this?" And I'm a little surprised. I think I'm good, but I'm a little surprised at how much they forget. And when I think of that in my own life, I forget a lot of times, especially when my wife is talking. So we there's a lot of moving parts to that. And I'm not saying it's a bad market. We just need to be extremely careful. Challenges that you can run into. There are a lot of advisors out there that look for immediate gratification. Not a bad thing. They need to be paid. I mean, home office people get paid every 2 weeks. They're on a steady paycheck, but sometimes challenges on the field is that a lot of these term plans out there. I mean, they're easy issue. They're getting uh, paid for, and the agent's getting paid for. Sometimes this market, it takes a little longer. You're working with double, triple, quadruple the premium in the mortgage freedom market, which brings in a lot of revenue. And sometimes the home office is looking a little deeper on health and financials. And so just know that sometimes it takes a little longer to get paid, but the reward is worth it. Debt, changing behavior. I think I hit that enough. Persistency. Um, the more persistent business we can all achieve, this includes the advisor, the client, and the home office, the better it is for everyone. I mean, if a client is keeping their policy, it's better for the advisor, it's better for the home office, and it's also better for the client because the client is getting a better rate of return, the home office is doing better, and when we need high quality, persistent business. It doesn't do any good for clients to come in and drop their policies. They need to understand what they're getting, and at the same time, it's the responsibility of the home office to be able to give high service, good quality service, and we need to make sure there's a good balance in there that they're able to service the kind of business that the agents are selling, so that the clients don't get frustrated. Stay with me. Stay with me if you can. Um, this is just kind of a review. I like to do this just to kind of I talk, you're not talking, I'm talking, and so I like to just review here some. The mortgage market, we've already established, you can be a gold mine. It's a huge market. You can, as IMOs, you can, as home offices, leverage your current relationships. I mean, most of you have the symmetries and the quilities and the first family lives and the AmeriLife's already contracted. This gives you a tremendous opportunity to go back into them and say, hey, listen, we can help you increase revenue. And that's what IMOs, that's what home offices are looking for. It doesn't do me any good to replace your revenue. We've already talked about that. My goal is to increase your revenue and increase your premium, not replace it. And I believe this market has huge potential to be able to do that, and a couple of other markets that we're going to be talking about today. I believe that home offices need to provide great education. Things are constantly changing. The carriers I work with do that. I firmly believe that they're much more than just product providers, that they're also education providers, they're direction providers. And I believe that the home offices that do the best, also marketing organizations that train, teach, educate, give value added in addition to the product will be the winners. Um, and we've already talked about these others. I think IBC is getting scrutinized. I wanted to talk about that. I love IBC. Um, I do IBC myself. That's infinite banking concept. In my travels, I unfortunately saw a lot of people that don't understand how IBC works, which just breaks my heart. IBC on its own is wonderful, and I think that it pairs very well with the mortgage market. Again, I don't want to repeat myself. I think the opportunities are with your existing relationships. I think you could immediately start having some Zoom meetings, educational workshops, get your home office up to date. A lot of you have intellectual property that you're not using right now, a lot of software that you're using right now. And a lot of you have relationships with existing IMOs. And these are gold mines for you that maybe you're not taking advantage of, and maybe you're just providing a product. I think there's good opportunity in the bank and mortgage insurance departments, and you can also attract new people with great ideas. Great ideas are gold mines. How it works. Let me get into the mortgage freedom. I just want to this is kind of a smaller writing here, but I just kind of want to go over, get my glasses here because this is kind of small writing where I'm at here, but how the mortgage freedom works. So you kind of know we're kind of getting into the meat of this market. When the cash value of the life insurance policy equals the mortgage balance. Okay, so if the mortgage balance is 200,000, the cash value is the mortgage balance. This is the mortgage freedom that I'm talking about. We then transfer, that's one loan, 15, 20 years down the road. That's one loan. Then we take a loan from the insurance company and we then pay the mortgage off. Okay. So we're taking a loan from the policy, or not from the policy, we'll get into that, but from the insurance company. The cash value is the collateral for that, and then we're paying the mortgage off. And so what we're trying to do is getting the bank out of the picture. So the client in the 15th to 20th year has now paid their mortgage off. Okay. What do we want to do then? Then what we want to do is we want to redirect the mortgage payments they were making at that time, and we want to redirect that back into the policy. We want to pay that loan off. And people ask me all the time, why do you want to do that? Well, the reason we want to do that is that in the 15th, 20th year, whatever time that you pay your policy off, or your home mortgage off, your life insurance policy gets better every year, every minute. The worst time for a whole life policy is the second that it's born. Every day it gets better from there on. In the 20th year, a whole life policy is just absolutely the most awesome vehicle because you've taken care of a lot of the expenses. And when people say, well, why should I put that back into the policy? You're getting a great rate of return. You're getting money that's safe. You're getting living benefits. You're getting guarantees. And the policy is getting more efficient every single day. The older a policy is, the better it is. And so we want to take that and then we want to replenish that policy because we've already established that that's the best place to put it. Okay. Now, what will that do? Okay. So we let's say we paid the policy off in the 20th year. So we now in the 30th year, we've taken the mortgage payments that you've paid to the bank and you've paid that to yourself. You've paid that into an infinite banking concept. And let's go to the next slide because this is a little more. We've kind of done a sample case here. This is a $400,000 mortgage, 6% interest, 30-year mortgage. The mortgage payers are 35 and 35. And what they've decided to do for this example here, we're gonna go through a real live example, is they've said, Terry, we can pay an extra $500 a month. And so that's what I call capitalization. And so, they can either do that to their, the Dave Ramsey way, they can refinance, but this is doing it into a mortgage freedom policy, a whole life policy. And so, in addition to what they're doing, they're putting this $500 into their policy. And with the hopes of being able to pay their home off anywhere between 10, 5, 10, and sometimes even 20 years earlier. As a matter of fact, yesterday I had a client that called me and he wanted to put $1,500 into it, and we're starting his policy. He was so excited about this that he wants to put $1,500 in, and that's a story I've been hearing quite frequently. So getting down a little bit more, this is using that example. And I have another video on this that goes into depth. This is just kind of a 10,000 foot view. But in the first year, the mortgage balance is $395,000. The cash value is about $4,000. You can see that. So that's not enough to pay the mortgage off. But if you take a look at the 21st year of this mortgage, okay, the balance of that mortgage is $194,000. And the policy value in the 21st year is $194,000. So like I said in the previous slide, what we're doing is we're taking that cash value and we're getting the bank out of our lives. I have good friends that are bankers. I live in a banking town here in Charlotte. I'm not against bankers. I'm not against banks. I just want to be able to use what they do to my benefit, not to their benefit. And so we've got the bank out. We're now using the bank concepts for us. This is kind of a graph. That blue line is your mortgage balance going down. If you see, we use the $400,000. And the red line is your cash value in your policy. Extremely important. And we're going to do this on the next slide, but I want you to understand this. Notice that when we pay your mortgage off, the red line doesn't change. This is the essence of infinite banking, and a lot of people don't get this, is that when you take a loan, you're not taking a loan from your policy. Your policy is growing uninterrupted. And so that red line continues to move up, okay? Now, you're getting a loan from the general funds of the life insurance company, and you're a mutual company, so you're getting some of the profits from the company. And so that line is continuing to move up. That red line is continuing to go up. You still have cash value. You have a lien against it. And what the goal line is taking that $2,400 a month. That's what your mortgage payment was. And we're putting that back into the policy. And if you do that for a period of 10 years, you put that mortgage payment back in, so you're repaying the loan off, you'll have $300,000 plus at the end of your original 30-year mortgage. I mean, that is absolutely awesome. That is banking at its best. That's taking advantage of uninterrupted interest. Sometimes banking can be a little ambiguous. What am I doing this banking for? This banking is to pay your mortgage off and get the bank out of your mortgage business. This is being able to save 10 years of mortgage payments. And again, I have another video on this. Let's review this very quickly because I want IMOs and home offices to understand this. Please notice, like we said, the cash in your policy continues to grow. That's a banking secret. You can't take a loan from your policy. You take a loan against the policy. Your policy is your security. When you want to pay your mortgage off, there's no application like you have to go to when you go to the bank. You just basically have to answer two questions. The life insurance company, once they identify who you are, they're going to want to have the answer to two questions. Do you want a check or do you want a wire? okay? And the companies I've been fortunate to work with, and I've worked with great companies, ask you, do you want that, do you want us to send you a check or do you want it wired somewhere? And like I say, you own the banking concept. And in one of my slides, I always put caveats in there that when I talk about banks, I'm not talking about literal banks. I'm talking about banking concepts. And I want advisors to know and be careful how they use the word bank. If you're a bank, you got to be chartered, you got to be state approved, you got to be federal approved, you got to have FDIC insurance. What we're doing is we're taking advantage of banking concepts that's made trillions and trillions of dollars, but you're not a bank. This is you're taking advantage of banking concepts. And I like it's maybe my home office coming into play, but you're taking advantage of banking concepts. At that point, you have the bank out of your life. And Nelson Nash said that his life became so much better when he got the banks out of his life. And again, nothing against bankers, please. Uh, this strategy, this marketing strategy is long term. Um, you know, we don't want to cut back on term insurance. We want to sell more term. We convert a lot of the term. Been in the market a few months. My number one goal is to protect the family first, and a lot of families are not ready for this yet. So I have sold some term policies. I only sell term that's convertible and high quality. We have very few loans on this. There's very little service. And again, I want to emphasize this. I want this to be an underlying theme that I want this to be an add-on and not a replacement. Are you with me? Okay, that's the mortgage market. Lots of potential. The second market I want to talk to you about is the what I call the perpetual multi-generational fund. And I'll explain that. Listen, we are in the very first quarter of the largest transfer of wealth in the history of mankind. Maybe the end of the first quarter, maybe the start of the second quarter, but we're in the midst of this great transfer of wealth. There's trillions of dollars in IRA money and in qualified money. And there are people like my parents, like me. I'm a grandfather to 9 grandchildren, and I want to leave something to them. And I want to leave something to them that will maximize the efficiency of every dollar that I pass on. And I have a video on this as well, presentation on this as well. But I want to bless their lives in the most efficient way possible. And in my opinion, I've been in the field and I've been to thousands of offices. I don't think we're taking advantage of this. And I want to be able to pass something on to my children that when I'm gone, that it's not just depleted, so it doesn't dissipate in a few years, but I want to use a product and a financial vehicle that will actually increase in value for them over their lifetime, where they can leverage over their lifetime, and that it's perpetual, that maybe they can bless their children and my great-grandchildren, my great-great-grandchildren. And so I want to build generational wealth. And I don't consider myself ultra wealthy, but I want to be able to help my family and those that I love. I don't want to just give them something where they spend it and it's gone and they forget about it. They don't need to remember me, but I want to be able to bless their lives for their whole life. So that's what this plan is all about. Let's take a sample case. Grandparents, 70, 71, granddaughter, age 1, Jolene. I have a granddaughter, Jolene. This isn't her. I love her name, so I use Jolene. And these grandparents want to give her in the most efficient way possible. They don't know yet, but they want to be able to gift her at some time $40,000 to $50,000. Okay, that's what they have. it can be more, it can be less. This is just a sample case to show the idea of this. And in talking with this family, this is very common. They want to be able to have educational funds available for Jolene. They want to be able to have emergency funds in case something happens where they can have it for an emergency. They want to be able to have her to be able to have access and liquidity for it for meaningful purchases that will bless her life. Hopefully take advantage of taxes, where some taxes are voluntary. And I tell my clients that is that, some taxes are voluntary, and that if you don't take advantage of the law, and I'm not one for not paying taxes or using shady methods, but there are some laws that we can take advantage of that are totally legal, that a lot of the wealthy take advantage of, that can help bless people's lives. Again, going down the list, we want living benefits for unforeseen reasons. I would like this to be legacy. I'd like to be able to have this gift, even though it may not sound like that much, to be able to bless her life, not only now, but bless her life forever, and hopefully pass it on to her children if she has children, or her grandchildren. I want this to continue to go on. Kind of like here in North Carolina, we have a mansion up in Asheville, the Vanderbilts. I want to be able to my goal isn't to be like that, but I want to be able to have this be multi-generational. Want to be able to, I'm a little worried about where government retirement's coming from, and so if I had my choice, I'd like to be able to provide for a Jolene for supplemental retirement in case the government's not around and retirement's not around. And probably most important is I want safety and guarantees. When I give a gift, I want it to be safe. I want it to have guarantees. Yes, rate of return is important to me, but I want this to be safe, and hopefully be able to bless her life in perpetuity. And that's why we called it the multi-generational fund. So let's take a look at this. Again, just an example. We used $41,000. Okay. We put that into a premium deposit account. That's accounts where life insurance companies have, where you can put money in and it'll pay the account. You don't have to worry about it. It's a one-time dump. And what most insurance companies do, they'll give you a discount on future premiums. And so this one right here actually gave a 5.25% discount, which to me is like money in the bank. That's like getting a 5.25% rate of return if they're giving you a discount. Okay. So what this $41,000 will do is it will fund a 10 pay, because grandma and grandpa don't want to pay on this forever. And this will fund a 10 pay for 10 years. So they only pay on it for 10 years. They're only making one payment because that $41,000 will make that payment for 10 years. So you can already see that they're getting a great rate of return. 41,000 is buying a 10 pay that would normally be 50,000. So, and this explains in the third bullet point there, is this is a 10 pay whole life with an A+ rated company, been around for 125 years. Again, I want safety and guarantees. Now, I like to underpromise and overperform, and with my clients, and how you teach your agents. Number one, that $40,000 that we put in, that $41,000, this will provide sweet Jolene with $75,000 at age 18 for education. Maybe it won't pay for all of her education, but it will certainly help. In year 10, in case something happens, there's an emergency fund. This is the cash value of $50,000 in year 10. It has access and liquidity. From day one, it has access and liquidity to this amount of money. Not all of it, because there's some charges, just like with any financial vehicle. There's some tax advantages, yes, and I don't want to get into that now. And I always say consult with your tax professional. We recommend that. We're proponents of going to your CPA. We have nothing to hide. We want, there are some tax advantages to this that we can prove. There are living benefits. Again, we said that we wanted this to be a benefit for Jolene in perpetuity, but for her whole life. And we're going to show some of this. We want this to be multi-generational. Yes, if something happens to Jolene and she's used this policy the way we want her to use this policy and the way she's taught to use this policy, if something happens to her at age 67, she can pass on $1 million to her future generation. This can be supplemental retirement. We talked about that earlier. This $40,000 will provide Jolene with, this is almost unbelievable. I had to look at this several times, but it will provide Jolene with $750,000 if she uses this policy correctly at age 67. Okay, safety and guarantees, but that's what we've been able to do by this gift. Again, this is what you can train your agents on. I can help you do this. Now, did you know that according to AARP, that people will spend $600,000 in interest over their lifetime? Okay, this gift to Jolene, she'll be able to take advantage of banking strategies and concepts that have made banks trillions and trillions of dollars. But instead of the bank earning all of that interest, this policy can help Jolene. And I have, again, another video out that kind of goes step by step. And perhaps it's important to teach Jolene through this policy how she doesn't have to pay that $600,000 in interest, that she can use this policy to buy major purchases and to be able to capture that interest on her own. And we'll get into that. But isn't this awesome? Let's look at this. Let's look at this. Jolene does nothing with it. Let's say that she decides that she doesn't want to go to college, or she wants to go into the military, she wants to learn a trade, whatever. But at age 18, she has 70,000 for college. At age 30, 130,000 perhaps for a down payment on a home. At age 40, 208,000. Remember, you've only put 40,000 into this. At age 50, 332,000. At age 60, she's got 526,000. Maybe she can pay off her second home or her first home. At age 70, she has $821,000. Why so much, you ask? Well, I'm not saying that she hasn't used this money along the way, but if you understand the banking concept, what you want to do is teach your children, number one, there's nothing for free, and number two, that to recapitalize their banking concept. So let's say that she took out 50,000 for college. Okay, well, if she had gone to a bank and borrowed 50,000 or gotten financial aid, she'd have to pay that back. Okay. My dad, when I wanted to go to college, said, well, that's wonderful. He was a farmer, wonderful man, one of the smartest men I've ever met. He did not have a college degree. And he sat me down and said, if you want to go to college, you need to pay for it. I'll help you if you get into a jam, but you need to pay for it. And so we want to teach our children, our grandchildren, at least in my opinion, there's nothing for free. And if you have money for college, yes, it is a gift, but it might be a good idea to recapitalize that. Why? Because it's going to work to your advantage. This will be a gift that keeps on giving. And you can see that if she pays those loans back, she's paying it back to herself in essence. It's going back into her banking concept policy. So why would you not want to do that? Why would you not want to use that as your vehicle? Okay. So that's the perpetual multi-generational plan that I think has a lot of just awesome potential for your agents. The third area that I'm going to touch on that I have exposure to, that I know, I've recruited a lot of college planning, is college planning. college is probably the biggest expenditure we will make outside of our mortgage. And I don't know if you've looked at stats, but college costs are rising faster than inflation. And people say, well, why? And it's because they can. And I help pay for my children's education. And I have to say that the money that I put in was worth every penny when I saw them walk around the stage. When I think about it, I could choke up and get tears in my eyes with the happiness from their accomplishments. But colleges know that they have people like me that will do anything possible because we'll pay to help our children be able to realize their dreams. And so why would we not want to help our agents or our field force learn how to deal with college planning, especially since it will be the second largest outlay over their lifetime? Personally, I'm perplexed why planners, financial planners, so-called, don't address this. And let's just dig a little deeper in this. The FAFSA form, you can look up online, but is the foundation not only for possible government aid, but also assist in determining other aid. And so that's kind of that's what, if you're going to get a scholarship, if you're going to get financial aid from the college, if you're going to get private financial aid, what they all look at is this FAFSA form. Everyone looks at it. Okay, that's what you fill out. Not only the college, but everyone's going to look at this FAFSA form when your children or grandchildren go to college. Prior to 2023, there were 108 questions. I mean, geez, it took a long time. It was harder than filling out your taxes. Now they're down to 48 questions because it pulls information from your tax returns. Now, according to collegedata.com, and I recommend that you Google what is not included on the FAFSA form as far as assets. And if you Google that, you'll see that life insurance, annuities, and retirement plans don't count against you on the FAFSA form. They're considered to be retirement vehicles, which they are, and that could, not guaranteed, but that could help your children and grandchildren prepare for college and to be able to open up some possibilities for other funding, other scholarships, if you transfer some of that money into some of the vehicles that we use, and we also get safety from that. Let me just use a quick example just to kind of show you. This is a real life example. This is a person that I'm familiar with. I'm not familiar with the girl, but I'm familiar with the advisor. This is a female that was accepted to Rutgers, smart girl. And her parents' assets, in addition to their retirement assets, they had approximately $700,000 in a brokerage account. I don't want to say what brokerage account because they're probably still mad at us, but it was in a brokerage account. The cost of attendance to go to Rutgers was $78,000 a year. And I believe they had a little bit of help on top of that, some type of aid on top of that, but their cost of attendance was $78,000 a year. This advisor showed the parents how to reallocate their assets into a single premium whole life, and also some of it into an indexed annuity where they can still get some market appreciation, less the risk. And this girl's cost of attendance went down to $14,000 a year. True story. And so I think this offers, there's a lot to this. There's some training modules out to this. It's not as easy as I made it look, but these are three areas that I believe that could really help insurance companies and marketing companies being able to help increase your production, increase your revenue. And I want to thank you for your time. Thank you for, I wish everyone success. If I can be a benefit, great. If not, I'm good with that too. Thank you.